Have you looked at your home insurance bill lately? Across the United States, a quiet crisis is brewing that could threaten your home's value. Premiums are skyrocketing, insurers are fleeing entire states, and millions are being left underinsured. Stay until the end to see how you can navigate this mess. Before we dive into the deep end, please subscribe to our channel so you never miss an update on the financial topics that matter most to you. Today we are breaking down the home insurance crisis in the USA step by step to understand what is happening and why it is happening now. Step 1. The premium surge. In the last few years, the average cost of home insurance has risen by double digits in many regions. A major driver is inflation. The cost of labor and building materials like lumber and steel has soared, making it more expensive to rebuild after a loss. Because insurance is designed to cover the replacement cost of your home, those higher construction prices translate directly into higher premiums for you. Step 2. The increasing frequency of natural disasters. We are seeing more billion-dollar weather events than ever before in recorded history. From hurricanes in Florida to wildfires in California, no region is truly immune. The risk profiles of many states have shifted dramatically. Insurers use complex modeling to predict these risks. When the models show a higher probability of total loss, your rates reflect that increased danger. Step 3. Insurer withdrawals. Perhaps the most alarming part of this crisis is that some major companies are stopping new policies altogether. When big names like State Farm or Allstate exit a market, it reduces competition, leaving homeowners with fewer options and even higher prices. Take Florida, for example. The state has seen a mass exodus of private insurers, forcing more residents into the state-backed insurer of last resort. Step 4. The role of reinsurance. You might not know it, but insurance companies have insurance too, and it is getting very expensive. Global reinsurers have hiked their prices due to worldwide losses. Those costs are passed down the chain until they reach your monthly statement. If an insurer cannot afford their own reinsurance, they cannot safely cover your home. It is a fundamental shift in the global insurance economy. Step 5. The impact on your wallet. For many, home insurance is no longer just a bill. It is a barrier to home ownership and financial stability. Many homeowners find their mortgage payments spiking because of escrow shortages, all driven by the surge in insurance premiums. Worse still, some are choosing to go bare or underinsure their properties to save money, leaving them vulnerable to financial ruin if disaster strikes. Step 6. The mortgage connection. Most lenders require insurance as a condition of your loan. If you can't get it, your mortgage is at risk. If your policy is canceled and you don't find a replacement, your lender will buy force-placed insurance for you, which is often twice as expensive. This can lead to a death spiral where homeowners can no longer afford their total monthly payment, leading to potential foreclosure risks. Step 7. Regional case studies. While the crisis is national, certain states like California and Louisiana are at the epicenter. In California, repeated wildfire seasons have made large swaths of the state essentially uninsurable by the traditional private market. In Louisiana, the collapse of several smaller regional insurers after multiple hurricane seasons has left the state-backed market overwhelmed. Step 8. The danger of being underinsured. Even if you have a policy, it might not cover the full cost to rebuild in today's market. Market value is what someone will pay for your house. Replacement cost is what it takes to actually build it back. The gap between them is widening. Most people haven't updated their coverage limits in years, meaning they could be 20 or 30% short if a total loss occurs today. Step 9. How to take control. Home hardening is one of the few ways you can proactively lower your risk and potentially your rates. Upgrading to impact-resistant shingles or installing hurricane shutters can make your home much more attractive to the few remaining insurers. In fire-prone areas, creating a defensible space by clearing brush and trees around your home is now a requirement for many insurance renewals. Step 10. Looking ahead. What will the insurance market look like in 5 years? Experts say we are in for a fundamental restructuring. From reforming litigation laws to creating federal reinsurance backstops, the solutions will require both state and federal coordination. The era of cheap, easy-to-get home insurance may be over. We are moving toward a future where risk is priced much more accurately and expensively. In summary, the U.S. home insurance crisis is driven by a perfect storm of inflation, natural disasters, and global financial shifts. It requires a proactive approach. In Florida, the crisis is compounded by litigation. For years, the state accounted for a massive percentage of all home insurance lawsuits in the U.S. A key issue was assignment of benefits, where contractors could sue insurers directly, leading to massive legal costs that drove premiums up for everyone. Recent legislative reforms aim to curb these lawsuits, but it will take years for the market to stabilize and for those savings to reach your bill. In California, as private insurers retreat from wildfire-prone areas, more homeowners are turning to the FAIR Plan, the state's insurer of last resort. The FAIR Plan provides basic fire coverage, but it is expensive and doesn't cover liability or theft, forcing homeowners to buy expensive difference in conditions policies. Texas is facing its own crisis, driven by a surge in severe convective storms, hail and wind events that cause billions in damages every single year. Unlike hurricanes, these storms are frequent and unpredictable, leading to a constant stream of claims that make Texas one of the most expensive states to insure. Insurers are now using AI and satellite imagery to inspect your home from the sky. They can spot a mossy roof or a trampoline you didn't disclose. These digital inspections mean policies can be canceled with very little notice, sometimes just based on an algorithm's assessment of your roof's condition. The age of your roof is now a critical factor. If your roof is over 15 or 20 years old, you may find it impossible to get coverage from a major carrier. Your credit score also plays a massive role. In most states, insurers use a credit-based insurance score to predict how likely you are to file a claim. A lower credit score can mean significantly higher premiums, even if you have never filed a claim in your life. It's an often overlooked part of the bill. Your home's proximity to a fire station and fire hydrants, your public protection classification, is another major factor in your premium calculation. When an insurer goes bankrupt, state guarantee associations like FIGA in Florida step in to pay outstanding claims, but this often leads to surcharges on everyone else's policies. A growing number of homeowners who have paid off their mortgages are choosing to self-insure by dropping coverage entirely because the costs are too high. While this saves money in the short term, a single disaster could mean losing your life's work and your primary residence with no safety net. Understanding your declarations page is the first step in taking control. Look closely at your Coverage A, the cost to rebuild your structure. Raising your deductible can significantly lower your premium. Moving from a $500 to a $2,500 deductible could save you 20%. We recommend shopping your policy at least every 2 years. Loyalty to an insurance company rarely pays off. New customer discounts are common. Look beyond the big national brands. Regional carriers or specialized insurers often have better risk models for specific geographic areas. Community-level mitigation, like better local building codes and community wildfire protection plans, can eventually lead to lower insurance scores for whole neighborhoods. Homes built to the latest codes are much cheaper to insure because they are statistically much less likely to suffer a total loss in a storm. A new trend is parametric insurance, which pays out a set amount based on a trigger event, like a Category 4 hurricane hitting your zip code. Parametric policies pay out almost instantly, providing the cash you need for immediate repairs without the long wait for a traditional adjuster. Bundling your home and auto insurance is still one of the most effective ways to get a multi-policy discount, often saving you up to 15%. Ultimately, we are entering an era of risk-adjusted living, where the cost of protecting our homes is a major factor in where we choose to live. Step 11. The impact on the real estate market. High insurance costs are starting to devalue homes in high-risk areas. In some coastal communities, we are seeing insurance contingent sales where buyers back out after realizing the premium will double their monthly carrying cost. This reduction in market liquidity could lead to a broader economic slowdown in states heavily dependent on real estate development and tourism. Step 12. The rise of climate migration. Some experts predict a mass movement of people away from uninsurable regions toward the climate haven states. This migration isn't just about the weather, it's about the financial impossibility of staying protected in areas hit by repeated natural disasters. We could see a great reset of American housing, where populations shift toward the Great Lakes or the Northeast to escape the soaring costs of the Sun Belt. There is hope in community-wide solutions. Neighborhoods that band together to improve drainage or fire breaks are seeing better collective insurance scores. Investing in municipal resilience infrastructure is no longer optional. It is a vital part of maintaining a local economy's insurability. Blockchain and smart contracts could also revolutionize the industry, allowing for automated payouts and more transparent risk pooling models. By removing the administrative overhead of traditional carriers, decentralized insurance could provide a cheaper alternative for some high-risk communities. Real reform will require a new social contract between homeowners, insurers, and the government to share risk more equitably. This crisis is a wake-up call. It's time to rethink how we value, build, and protect our homes in a changing world. In our final segment, we will look at the profitability of the top insurers. While your premiums go up, are they still losing money? We'll examine the combined ratios of carriers like State Farm and Progressive to understand their side of the ledger. We'll also provide a specific step-by-step checklist for anyone facing a non-renewal notice this month. Our best advice? Compare policies every single year, consider a higher deductible if you have an emergency fund, and invest in home hardening today. Thank you for watching this deep dive. If you found this helpful, please support us by liking the video, leaving a comment below, and subscribing for more.